Good morning, everybody. Welcome to the Flow Show. Morning, Kay. Morning, Stel. How you doing, guys?
Good morning.
Hello, good morning.
Good morning. Good morning.
All good?
We all good?
Absolutely.
Good to hear.
And you?
Hey, yeah, I'm all good,
Despite
mate.
the loss yesterday.
Yeah, disappointing.
Yeah, but Liverpool are always tough to beat.
Yeah, but they cheated us out of a penalty as well, so
yeah,
lots to moan about. But no, it was a good performance. A few weeks ago we would have lost that 3-4-0 probably. So still an improvement.
Good recovery near the end of the season. Unfortunately, a bit too late, but you're gonna make it, right? You're gonna stay on the Premiership, aren't you?
Yeah, we should do.
Yeah,
we should do. Barring a collapse, an Arsenal-style collapse. But no, we should be all right. Should be all right.
Good.
Okay, let's get stuck into it. I'm going to start with a little bit of data. Not been too much out today. Spanish retail sales and unemployment rate.
We don't see your screen, mate.
Oh, don't tell me that's happening again.
Yep.
And before you start talking about news and data, it's not an Arsenal collapse. It's just that we, the Blues, are just too good.
No, excuse me. We started their collapse when we got a draw at our place. They've been crap ever since. Can you see my screen right now?
Yep.
Yes, sir.
Good. So, yep, as I was saying, Spanish retail sales coming in at a nice big beat. Year-on-year numbers, 9.5% versus 0.7 expected. So, as I say, quite a significant beat there. Unemployment not looking too great though, rising in Q1 to 13.26%, higher than expected, higher than last month. So a bit mixed there. A bit of consumer confidence data as well today. Business confidence in Italy a little softer. Consumer confidence a little better. Also, we had the Eurozone economic sentiment numbers coming out. Missed expectations, but still a rise on the month. Some of the components a little bit mixed. What is really important is this consumer inflation expectation and selling price expectations, because as we know, the ECB is all about inflation expectations, because they see that as a strong reason why inflation moves. If people are expecting inflation, they adjust their purchasing, buy stuff now because it's going to be more expensive later, that sort of thing. This has come off some really big highs of late. We can have a quick look at that. Particularly over last year, it was, as you can see, running very hot, and now it's been sliding all the way back down. So pretty much for most of last year and into this year, the numbers are coming down. So that will give the ECB, particularly the doves, the ammo to say, well, higher rates is affecting inflation expectations. So things are calming down, which should, if the rule of thumb follows, should keep inflation from running too much higher. We wait to see how that goes. But selling price expectations as well coming lower. Again, that's from the business side of things. So firms, how they think they can achieve prices, and whether they put prices up or down. So some good news for the ECB there from those numbers. ECB's Herodotou said that wage growth is a challenge that must be watched. We're beginning to see the first signs of the impact of rate hikes on the economy. De Guindos said labour market in the euro area is quite impressive. We'll have to take tightening of financial conditions in the bank lending survey into consideration. So that's what he's watching regarding how monetary policy is being transmitted. Kicking back to the data yesterday and in the US, durable goods came out. a decent number, 3.2%. Again, beating expectations, higher than last month. Looks like maybe some of that was, well, usually we look at the big ticket items. So you get aircraft, defense, that sort of thing. And those numbers can swing this around quite significantly. But if you take out the defense stuff, then it's down 0.4%. So that suggests that there's some big, maybe some aircraft stuff in it, non-defense stuff, but big ticket stuff, as we like to call it, as opposed to white goods, such as appliances and that sort of thing. So not particularly hot on the numbers. The core durable goods was a positive though. So again, it's another data point, has some good, has some bad, nothing that really stands out saying, anything's booming or busting at the moment, which has been par for the course for the data of late. Over to what's going on in the banking stuff, and advisors have apparently lined up potential buyers for New Republic stock, or new First Republic stock. Apparently, so this is stuff that is, if they issue new stock, there's some potential buyers in the wing. CNBC sources reported that the US government is currently unwilling to intervene in First Republic.
So basically, this new stock is going to be called the Second Republic, right? Sorry.
Yes. It's like Star Wars, the Old Republic.
Yeah.
And they also say that no one is expected to buy First Republic stock without substantial federal guarantees. So if you want this bag of poo, you're going to need some free air freshener to go with it from the government. This First Republic stuff is causing a bit of these moves we're seeing in markets, as we saw yesterday when that headline dropped, that there were potential purchasers lined up. That saw a rally in yields and the dollar. So a clear signal of what we're trading at the moment. We are also trading, well, I don't know how much we're trading it, but this debt ceiling rubbish is still going on. The Republicans passed their bill, as you would expect in their house that they hold the majority over. So they passed their bill over the debt ceiling, which, as expected, got a short shrift from the other side, from the other party. So, it's still at deadlock. BlackRock apparently say that they've been adding US 10-year treasuries to their books as the debt ceiling worries intensify, and also on the back of the economy potentially softening this year. So they've obviously filled their books and now telling everyone else what they've done, so anyone else can give them some profit by jumping in the same way. This bank and debt stuff, how much do you think it's affecting markets at the moment, guys?
The banking situation with
the debt stuff
and all that. Yeah. It's well, there was a big scare a couple of weeks ago, right? And this is just echoes of that now. But I don't really know what to make of it. From the what was it called, Silicon Valley Bank collapse, the clear message was that deposits are guaranteed, and basically stockholders and bondholders are screwed. So I think the main thing is for there to be a sense of security in terms of people having the money with certain banks. On the other hand, if you're investing in their equity or bonds, then that's your own problem. So I think that's why the market is really not worrying that much about it. Of course, we have broken down a little bit in the S&P, and equities are moving a little bit lower, but this is hardly any panic. So for me, the fact that the precedent has been set, and it shows that really the only risk holders are the equity holders and the bond holders, I'm actually feeling relatively okay with that. And if anything, the big banks, because really that's what we should be worried about, the Bank of America's and the Wells Fargo's, they are coming out better out of all this. So as long as they are okay, I think everything else is going to be a little detail. It's unfortunate people are losing their money on stock and on bonds, but in the grand scheme of things, I don't think it should be something to worry about.
Yeah, I'm just wondering if the fact that no one's riding to the rescue of First Republic is maybe getting a few jitters going. That maybe if they go, who else is circling the drain, should we say, about that? And what about the debt ceiling stuff, Kay? How much influence do you think it's having?
I think it's a mix. If the question is how much of it is impacting the market, I'd say it has some sort of an impact. It's not only weakening data in the States that are weighing on the dollar and the stocks. And if we see the earnings, some of them are missing, other ones are better. I don't think. But it's like one big pot of net, impacting everything a little bit now, and the market a bit nervous, and yeah. So I mean, there's undeniably some impact, but there's a lot of stuff, a lot of little things going on at the same time, which keep the market on its toes, and yeah. So I think there is a bit of an impact. Well, there is actually an undeniable impact if you look at the combination of SVB, then the rest, and then Credit Suisse and stuff. It has made the market think a bit. But there's so much going on at the same time, but not one thing, not one big catalyzer to shift markets around for a long-lasting time. But yeah, I think it undeniably has had or still has some impact. But is it the main driver of the market? It's hard to put one main driver on the market right now.
Yeah.
It's not even geopolitics. Although geopolitics have some sort of impact on some currencies. If you look at the CNH, perhaps if you look at the antipodians with the commodities having come off and all. So it's difficult to point the finger at one big catalyzer that moves these markets, and that's why we also hang around in ranges. Apart from the fact what we've seen over the past, call it nearly 2 months, really, that the euro recovered versus everything. That big rebalancing is I don't know whether it's going to end at the end of this month, whether the bigger players will have all the euros and euro assets that they want. We won't know. We only will see when they stop buying those euro crosses, etc. But yeah, I mean, for the rest, it's tough to put one exact catalyzer on what is really driving the markets. There's a lot of little things that at times take the upper hand, and that's it.
Yeah. I think as the saying goes, it's like a lot of spinning plates in the air, and every so often one of them wobbles, and markets move. Maybe one of the best ways to describe it. But anyway, let's move on to the BOC, and they had some more waffle out about their last monetary policy meeting, saying that the discussion ahead of the April 12th rate meeting, the decision was focused on whether monetary policy was restrictive enough, and they discussed whether it was best to raise its policy rate on April the 12th or wait for more evidence. So a little bit of a hawkish tilt in that line. But it was the view that inflation was declining in line with the bank's forecast, and more evidence would be needed to assess whether monetary policy was sufficiently restrictive. Well, as we know from the CPI data we got last week, that was probably the right stance, given that inflation dropped in that latest reading. Now, speaking of geopolitics, we did get a few headlines popping up yesterday that might have been something, but ended up not really being anything. Headline popped up that China's Xi had a phone call with Ukraine's Zelensky. The Chinese foreign minister afterwards said that in the near future, they will send a delegation to Ukraine and other countries in an effort to help reach a political settlement of the crisis. Zelensky's response, pretty much straight after that first headline dropped, said, "I had a long and meaningful phone call with President Xi, And I believe that this call, as well as the appointment of Ukraine's ambassador to China, will give a powerful impetus to the development of our bilateral relations. So nothing there to suggest that anything big had come of that phone call in terms of resolution of this war going on. But later on, he did issue another comment saying that there would be no peace at the expense of territorial compromises. Now, if you remember back, China had already put forward its own plan for a resolution, which got knocked back by Zelensky. That still remains the case from what I can tell via the news wires and comments and headlines and stuff. I thought we might get a bigger, or get a move on risk just on those headlines, the fact that they talk, but the market seemed oblivious towards it. Is this just pie in the sky stuff, just light waffle, or are we potentially heading somewhere, guys?
It's tough to tell.
It did have some sort of an impact if you look at the euro, because euro dollar was trading around where we are now, actually. So after the fact, it just came back. But then just after he decided to send one of his ex-ministers as an ambassador to China, euro did tick up 50 points. But again, how much of this is Ukraine, how much of this is end of month stuff, that we likely will never know. But anyway, I mean, we were here in the euro dollar, it moved higher a bit, and then we came back here on the fixings afterwards. So yeah.
Is that this move here? Was that the?
I think it might have had something to do with it. It might have. At least because I was like in a very short-term punch short euro dollar from the 50s, and then when they came out, it was trading in the 30s somewhere, and then I bought it, and then like an hour later we were 50 points higher. Now, as I said, is it end of month? Is it that stuff?
Yeah,
I don't know, but anyway, if the impact was there, it was let's call it relatively short-lived, and we're back to watching what's next.
Yeah, because I was wondering, because I was off yesterday afternoon, and I was wondering what this move was here, which got up near that 111. We do know of barrier plays options at the big figure, so no surprise to see that suffer on a first hit, and a decent pullback there, as you can see there. That's why I like trading big figures and potentially barrier information as well, because when you get that first touch right up close, if they're strong enough, you get a big pushback from it, and that was big enough for 40-50 pips from that. So that would have been nice pips if you jumped on that one. I hope some of you guys did. Kay, did you hit that one at the top, or
I'm going to be very honest, I was not aware of any barrier at 111.
Oh, mate, you should read the chat room.
Yeah, but when? I really...
last week, I think I put it up.
Ah, yeah, okay. Last week is last century, mate.
Oh, I don't know why I bother sometimes. I really don't. Anyway, well, you know, there's one there now anyway, and so does everyone else. So barriers at there, 111 and at 112, which I'll probably repeat that in the room just to make everyone aware of that again. Just looking forward quickly, we obviously have the US GDP coming out today, which is probably the big number to look out for. Expected to come in at 2% versus 2.6% prior. Usually the first number is the most volatile for markets because we don't know what's going on. The revisions thereafter usually only move the market if it's a big variation to the flash number, and then the reaction is less and less the more times they revise it. So this one's probably going to be potentially big if we get a big move either way. So expecting 2% on that. If it comes in much higher and much higher than last quarter, that's likely to see dollar rising and yields rising again, because we back to soft landings as far as the market's concerned, and that will keep the Fed on the right side as well. If it comes in a negative, then I think we're going to see the dollar sold and yields drop, and the market getting a bit more dovish over the Fed and rates and stuff. So, as I say, I think this one's going to be a potential mover if there's a big difference to what's expected and what was last month. So keep an eye on that one in there. Right, that's a bit quiet at the moment on the headline front. You guys got anything you want to throw in?
No. No, nothing.
No. Okay, man.
No, just one or two comments. OPEC said that they don't see the need to increase the cuts right now. Oil's hanging towards the lows. They did fill gaps and came back down. That was one of the scenarios that we were talking about in the room as well. And then US and South Korea seem to up their nuclear cooperation to deter North Korea, but seen all the moves there, the military moves in China, Korea, whatever. I guess there's a little bit of a half an eye on what China is doing as well, and the North Korea is just the excuse, but that's still lingering below, well, below or even at the surface right now. So yeah, that's really the other lines I've seen. For the rest, we are, as you say, waiting for the GDP and tomorrow's Bank of Japan.
Yeah, and I was going to touch on that as well, because obviously this will be our last chance to talk ahead of the BOJ tomorrow. So just to remind that tonight, or depending on your time zone, tomorrow morning, we're going to be getting Tokyo CPI, which may be a bit of a mover as it's the first new data of April in terms of CPI. So that's going to come in before the announcement. Now, the timing of the announcement tomorrow is always up in the air. Because of the time change for us in the UK BST, it's now more like around the 4 a.m. mark as opposed to the 3 a.m. mark. But really, you've got to give it a sort of hours window on that front. I'm deciding whether I'm going to get up for. I think I'm going to get up for this one, seeing it's you readers first. I might get up for that data as well, or be up for that data. We shall see. Got to get some sleep at some point. Kay, I know you're going to be up for it. Any last thoughts going in?
So they say I will be up for it.
Are you going to be up?
Yeah, listen, I mean, I'm still the same. Base cases, they don't change monetary policy right now, but they may start to throw in some comments about that they are looking at what to do. That is very much the possibility. I do think it is roughly the base case in the market as well. So if we get that, we may see an initial reaction if they indeed say that they are looking at stuff and trying to see what they can possibly do. We could see an initial reaction, and then likely come back to where we were ish. Now the surprise would be really that they start to tweak some stuff. A surprise 25 BPs more, widening of the band, buying a little bit less ETFs or rates. But the thing is that they already very, very much under buy what their target is. Their target is about, I think it's about 90 trillion or so yen. Is it like, no, 12 trillion yen, it's $90 billion equivalent or so. 12 trillion yen target, so $90 billion target or max that they buy in those ETFs and the rates. But so far they've only done 140 billion yen this year, so which is about $1 billion. So they are well below. So even if they would sort of change that gap to a lower level, maybe again the market may have an initial reaction to it, but that's really not going to change anything at all. If they let's say half it, they're still only running at like 1% or so right now. So no, that's yeah. So my base case is that they are not going to change much, but the chances are there that they start to talk about things.
Yeah, exactly. And as you can see there, we've got the outlook report, which is basically their updated forecasts. And this is going to be big as well, because this is potentially going to indicate whether they're going to move their inflation expectations up closer to that 2% mark. Now, they like to give themselves a bit of a wide band, as you can see there, 4 pips in inflation. 3 in the core numbers there, but they can narrow it down a bit. So all these numbers still come in below 2%, and that's been in line with what the BOJ have been telling us in the main, that they don't expect inflation in the fiscal years to get above 2%. The question is, if they adjust these higher, maybe closer, put some 2% in there, maybe narrow it up a bit. We will also be getting fiscal 2025, I believe, coming into this one. So that will give us a further outlook, or more in the future look at what they think inflation is going to do. So there could be a surprise here if we see any of these numbers tick into or over 2%. That will indicate that at some point they are going to get to their target, and that's when they will start to change policy.
There are we already had rumors out, right?
Yeah.
Last week or so, that they are going to change it to 1.6 to 1.9 from 1.5 to 1.8. The rumors are that they will change it from 1.6 to 1.9. So if that's the change, then it's no surprise. Anything else should be a little surprise. Now you talk about 0.1% as well. So I don't know if the longer term folks are really going to jump on a 0.1% change.
No, I don't think so either, unless it's seen as a bit dovish, not getting anything up to 2%. But as I say, we shall see. So just another thing to keep an eye on the announcement, because they could stand pat as expected on policy and give us some gangbusting forecasts on inflation, which will make it far more hawkish. So several things to keep an eye on. Going to be busy tonight or tomorrow morning, mate. I think.
Yeah, I think that's what I said in the room as well. Whatever happens in the Bank of Japan now, it's going to move. The yen is going to move. Whether it's just an initial move and then come back, it's going to move, because the expectation level since Kuroda left and Ueda stepped in has just ramped higher pretty dramatically, really. The expectation level for changes to start to come, and we have already endlessly commented on that, and I stick with what I said already a good number of times. I think we are going to see a form of normalization. Now, how fast and how big it's going to be is up to Ueda. For the time being, he's over communicating, so I don't think that that he will come up with big surprises, but rather like this constant communication of preparing markets and preparing actually their own government to take matters in hand. But as we all know, I mean, if Japan changes their policy, it's going to have ramifications in a lot of markets. So because they are so much involved in American, European, Australian markets, it will have an impact if the Japanese whales are starting to move cash around, and if the market as well is changing their investment into Japan. And I've already read, and I don't recall exactly who it was, but it was one of the big boys who said that they are looking at upping their investments in Japan because some things may be on the move, so they are looking to up their investments in Japan. So it is going to move if they change. So but now we need to know to what extent to be able to judge what how much the value of the Japanese yen may change, you know.
Yeah, exactly. And speaking of prices, dollar yen seems to be warbling around, not going anywhere much. Yesterday on the show, I said we need to keep an eye out for this 133s, 132.80s area, and we got down pretty much to 133 on the dot before a bounce all the way up to 134. Pretty quick move there. That move came, we were heading lower, and I was thinking this is okay for my shorts. It's going to give me a bit of margin. And then we got that First Republic headline out, and that kicked us back up again. And we've been hovering around there ever since. 134 is the resistance at the moment. I'm not giving much to the techs at the moment, given the event we've got coming up tomorrow. So I'm just in management mode, see where things lie going into the BOJ tomorrow for my short position. But we've got to think about the dollar side today. Still, what do you think? What's going to happen if we get a good number? Is a rally in yields and the dollar going to be sustained, or is sentiment going to change again and everything's happy and ice cream and sunshine, or will that get hit hard again? Any sort of rally in yields?
It's a good question. Good number. Well, define good.
Well, let's say it comes in at 3.5% on GDP.
Yeah. Okay. I mean, if that's, well, again, though, the problem. What's the problem that the Fed has had for the past year and a half? Inflation. That's really the main driver of everything at the moment. Obviously, other data points like employment and GDP, they will tend to show which way inflation is going. But for me, I know it sounds crazy, but these are secondary after inflation. Having said all that, if we get a really big blowout number, 3 handle, then we will definitely see, I think, a bigger move in yields than in equities, and that's because the market's still pricing cuts. Let me just open the quote list to see exactly what's pricing. Last time I checked was 75 base point cuts by February, and it's pretty much the same. That's aggressive. If growth is still doing well, and as long as employment doesn't collapse, which it hasn't yet, we're seeing a little bit of a move recently towards softer jobs, but really overall, if you look at the last 12 to 18 months average, we're still around pretty stable levels. So if growth and employment both remain relatively strong, then I think these cuts need to be taken away by the markets, and that's why I think yields are going to be moving more than stocks. But really, it will take a proper big surprise, like a 3 handle in the GDP and above. And having seen the recent trend in data, I mean, the trend is for softer data. That's without a doubt. So for that reason as well, it's an added reason why a big surprise would be would give a strong market reaction. And as I said before, I think yields would be moving more. So the 10-year US, 345 at the moment, I think we will easily go towards that 360 level, which is the next resistance. And I think that could be done within a day. I mean, without exaggerating. If we get that really strong number today, we'll get there today. But I fear that the number is going to continue to come in weaker. That's my view. And that's why I said yesterday on F.A.C.E, I think, or on the morning edge, I said, if you put a gun to my head, I'll still be buying Eurodollar. And maybe that's one of the reasons why we hit the 111 earlier. But but yeah, I think that's a trend. And unless we get some big surprise from the US, I think that trend will continue.
Yeah. And what do you think happens in stocks? Because it doesn't seem like it's taking, stocks are listening to anything really. We're sort of still creeping sideways. A little bit of a soft tone, I think, because we've come down through this 41, but we're still not doing an awful lot. Will stocks react to good or bad data, and which way?
Yeah, well, that's the thing. Stocks are pulled by two directions, and if it's good data, then the negative of that is rate cuts that get taken out, so higher for longer, and that theoretically is bad for stocks. I mean, that's what we know for the past 15 years. Higher rates, bad for stocks. Low rates, good for stocks. But on the other hand, if GDP growth looks like it's robust, then hey, this is good for the economy. So really, that should be good for stocks. So I think stocks are still trying to find any reason they can to remain relatively buoyant. And if you look at the last 2023 performance, we've had 200 point or 250 point range in the S&P, and it's relatively steady. We're not collapsing or rallying to the moon. It's very sideways, and unfortunately, I think it's going to be continuing that way for the foreseeable future, while yields move a lot more. Either way.
I agree.
Yeah.
Yeah, I agree. Well, and this is, we've had obviously the big bull rally, and things have come off a bit. But even so, we haven't even got, if you take it all the way back from when the big rally started, we've not even managed to get down to the 38.2 of that, which, if you were looking at any sort of chart like this, you would think, right, well, a decent pullback to the 38.2, there's your test of the trend. If it holds, then maybe a push on to new highs. Obviously, we've given off a big chunk off the highs, but now it just seems that the market doesn't know what to do. The trend isn't broken. We know that, but it's having a little pause, and the pause is growing because it's really paused since last year, and that's all come amid the Fed hiking. So maybe that's what it is. Maybe there's just been a different allocation out of stocks into yields. More people are trading bonds, maybe because of the returns, fixed returns on yields, or if you want to park your cash up for an extended period, that's where you can put it into bonds and then a decent rate for 4.5%. And maybe that's the reason why we're going sideways. But I know everyone's always looking, because of what's happened over the last 15 odd years. Everyone's always looking for big moves in stock markets, and maybe now that rates are up, and rates weren't up during this period when we got the big bull rally, maybe now rates are up, it's a completely different market that we're trading, and we perhaps shouldn't expect to get big giant moves again and runs to all-time highs in several weeks. But what it does do, it sets up decent trading ranges for stocks, and we know where the levels are at the moment, up to the 42s down to the 38s. So a decent 400 points to mess around in should you wish to play it. Okay, you got anything in particular you want to show us, or Stel even?
I thought you were asking about those moves. I think
go mate, go.
I think, as I said already, I think going forward, bad data is going to be bad and good data good, and we've seen it. We've seen it on the last move in yields. The last move in yields was down, and the stock market went down as well. And I think that's once okay, this CPI is one thing, but if you talk about the let's say the other data like GDP, like job market and things. I think that's the influence there is going to be good is good and bad is bad. I mean, good could lead the yields back higher, and but the stock market after initial move perhaps lower the defense, because they have to reprice, the market has to reprice the cuts. Afterwards, if you get good data, there's actually not too much reason to sell the companies of the country, right? So I think, and we've seen that already, this kind of effect in the past few months, and that's I reckon myself going to be the main driver ultimately. So if data start to roll over, I don't see stocks holding up either. But the opposite may be perhaps a little trickier to trade, but still it's going to be fundamentally relatively the same, with perhaps some delay in the equity market. That's my view on those things.
Yeah, thanks, mate.
Showing
it was saying, we spoke about earlier this year, beginning of this year, coming in, saying, are we going to get a change in how risk is perceived as far as stock markets go? Are we going to change to good data is good for stocks and bad is bad? And I think we're as Kay points out, we're getting that now. So, you know, we're going back to the old ways, perhaps, which probably half of you to remember.
Yeah, and even if those claims have not really moved anything, we can only note that they are grinding slowly up, right? And I know, I mean, there's 240 or 250 or 230 or 250 doesn't make a big change, but we are now well above this 200K mark all the time, and it looks to be gradually creeping higher. So on the other side, get a weaker GDP and initial jobless claims that continue to go up, and the continuing claims that may, on the contrary, have a pretty quick effect on the dollar. But again, we are in month end, and flows will dominate likely until tomorrow rather than data. And then, as Simon rightly says, then we once it's all over, then we look at how it all panned out, and then a new direction may be taken.
Yeah, exactly.
I'm okay to show a few things, and perhaps concentrate on what's happening in the yen also.
Yeah, go ahead, mate. Let me pass you the baton. There we go. You're on mute, mate.
Whoops, sorry about it. Yep, I was on mute. So yeah, let's look at the yen stuff. Let's look at let's overlay quickly the cloud, which has been really watered down lately because of these yo-yo moves. But anyway, today it's the bottom is around 133.40. No, the top is around 133.40, and the bottom around 132.5. So the cloud is thinning pretty much, which, if you believe in Japanese clouds, this one will be even more spectacular, is an accelerator of moves. The thinner the cloud, the bigger if you stay below or above, the cloud watchers say that these could be really accelerators. Okay, it's still a big figure wide, but that's a lot less wide than we had before. So if it's very wide, we can say that it's a bit trendy. If it's thinning out, it's that the trend has been watered down, which we actually saw. But the thinner the cloud, the more the chances are that we start to accelerate one side or the other. So keep that in mind if you're watching the cloud. So it's just under where we trade. So that's for the cloud, if people are interested. The other one is here. We have been respecting this trend line, which comes in around 131.5 to when the Bank of Japan will come out. And this is around 132.5, where the bottom of the cloud is. So this little zone here, 131.5, 132.5, should be interesting enough to watch post Bank of Japan. And on the top side, well, 135.1020. That's going to be where if we get above and stay above, then there's going to be a chance to move back to 137, and why not 138? I reckon. But this being said, I really don't know whether we are going to have the strength, one side or the other, to really go and test the boundaries of the ranges. What the market is looking at is for a change of the Bank of Japan. So and I think it's already been traded in a while. Yeah, for a while. If you look at the commodity currencies versus yen, the Canada yen, especially Kiwi yen, Aussie yen have been really hammered. But stuff like the euro yen has been holding up pretty well, and sterling yen in a way as well. So perhaps if the Bank of Japan really hints that changes are imminent, perhaps these two could start to move as well, and we'll have a look at those. But For the dollar yen as such, I'm not sure. I guess there's still enough energy for it to go lower if they really start to hint at changes. If you wait up, on the contrary, says like, nah, we're going to wait for a bit, and we haven't really started discussing anything, then we could see a bit of a jump in the dollar yen, I think, in the short term, perhaps retesting this 135. Why not? That for it. In the euro yen starts to be interesting, right? We are very close to even December 2014 levels, and if you we have a bit of a trend line here, which we are testing or we have tested in October and then earlier this month as well. So we are on interesting levels in the euro yen. So keep a close eye on that one, because any hint at changes in the Bank of Japan could finally break the back of the camel, perhaps. And if we start to get below those levels, those lows that we've seen this week around 146.30.50, that could be a sign that we are at least going to test 144s again. But it's going to be yen driven, this one, for until probably the ECB. So, but watch out if we start to break below 146.30.50, okay? And then on the other side, of course, if Bank of Japan stands still, then what's gonna keep it from retesting 150 really, right? And yeah, this is now going too steep, but even if we look at here, we have to really go back quite long already in time to find really decent levels above there. If you look at the 78.6 of the big 2008-2012 decline, which is the GFC plus the European crisis, then we're looking at 153s. If this 149.75, call it 150 blows of the top. Okay. I've got my little ideas for the ECB, but let's talk about that next week. But if I look at the combination, I'm starting to think ECB may put a little bit of a top in the euro. So I'm giving you an bit of an advance spoiler, as they say, on my thoughts on the ECB. So as I was saying as well, the sterling yen, we've corrected down to this zone. This is really starting to be a traffic zone now, right? 165.45 to 165.75. This 45.75, I think you have to pay attention to what happens here if the Bank of Japan decides to start to give us hints at a change. We're turning around the middle part of this the latest yo-yo. So we're turning around here after having broken this wedge. I'd say keep a close eye on what's happening at the double top. If the double top decides to go, then we should be looking at probably mid 168s. If they really go all mellow, why not? You know, try closer to 170 around here also. So that for the sterling yen. The other ones, so we had this break, which would really this looked like a very, very decisive break. But then I want the people in the room to keep an eye on what's happening just below 88, the figure. And as a matter of fact, we did hit this low here just below. We hit this 61.8, and we bounced off it. So that's going to be the level that we watch on the downside over the Bank of Japan, right? And then the first one on the top side, I'd say watch 89. It's a round number enough. Where is it trading right now? I just don't have my eyes on it. Yeah, 88.40.45 is trading. Yeah, so watch 89. That's a good starter, I would say. But then a bigger one would be here again, a retest of 90. That would be a big one. And for this one in particular, looking at how Aussie behaves right now, we could be seeing a bit of a bottom around 66 on the Aussie dollar, but it's still looking a bit heavy in my opinion. So this one, on if they don't give us too much, but don't close the door, and we see a knee-jerk reaction on this one, this compared to the others, I would rather think that we are going to reject this at first. That's my view on this one. Kiwi yen, I'm really not interested. It's really, I don't know. I really don't know. It's trying to hold this channel or the range, or it's very undecided. This one, it's really looking. I can't really read too much into it. Of course, if we start to break below 80.5, it's going to go a lot lower. But then again, there's going to be a yen driver purely. I think it's less of a pure picture than the one that we have in Aussie yen. That for the yen pairs, I think, unless somebody. Oh yeah, no, the Canada yen, right? Where is it? Yeah, so the Canada yen. We've been talking about this head and shoulders and the break here. That it really traded, right? So I guess you're 98.70. We are at 98.10.15. Your 98.70 is your first marker. 99 figure 10 above, and then the shoulder here, that should be a big one, 99.5. If that would break, then we are going to move higher again. But again, and I've got a bit of the same feeling that I have for the Aussie. If we look at oils and gas prices, I'm not sure that the Canadian on itself can be strong enough to put a definite rally in here. So I suspect if we get back up here to these levels on a real knee-jerk reaction, that we may find some sellers again. So that's just the impression that I have. If in turn Bank of Japan, again, same thing. If they give us a hint that the changes, then I reckon we are going to be in for a test deeper, 97 figure 30. And why not go somewhere here in those 96s? That's a real possibility. I think if Bank of Japan starts to change their tactics, and as we said before, because it could be moving a lot of cash. It's not just what we think that is that may happen. We have to look really at what kind of flows a move by a central bank can set off. It's not just opinions that we are trading here, because in the end, flows will decide where a market goes, not one of our beautiful pictures. EuroCAD. Well, yesterday I showed this one, this trend line coming from 2015, and we tested it. Then I showed those highs here. We tagged them, and we are back trading a little bit lower. It has more to do with the euro finding a bit of a top right now. I'm not sure what's going to happen on the month end. We could even see perhaps some month end impact on oils also, and then start the fresh month on Monday again. But I'd say it's good enough a level since we tagged it and came back off it to keep an eye on it, and we're turning around. No, we are not turning around yet. So the first level of support could be around this 149.60s. But bigger will be anywhere in the 147 to 148, 147.5, 148. That's going to be a much more important zone, I think, on the EuroCAD. But already through the 149.60, some people may be a bit disappointed. And longs, the first longs getting out of their holdings, if there are many longs in there, because the speed of the move higher is telling me that at least in this part, there were not too many longs in there. Other euro crosses, yeah. Euro Aussie, it also rejected this prior high pretty fiercely actually, because we are trading back below 167. So this 167.90, we had a quick shot above, right? If I'm correct? No? Did we not move just above? Oh no, I thought we printed a 168 yesterday, but okay. Hang on. Okay, we didn't. So this prior high here from October 2020 is still very valid, around 168, 168 and a quarter. So that's one to watch, and we are trading still well above those broken trend lines. So 165 and a half and 164, the big the first decent zones, 164 especially, I think is going to be one that we should scrutinize if ever Euro Aussie makes it down there. And again, my little spoiler for next week, I think, unless ECB goes 50 and all very, very hawkish still, I'm starting to think about the euro for next week. Well, so that's it for the main euro crosses. For the dollar, sterling still rangy, 124, 40, 50 still. We're there, right? For post US GDP, low 124s. And then the 123.80 to watch if we start to move back above 124.85.90, retesting the 125s possible. I'm a bit with Stel. I'm not sure that this US GDP is going to be a big mover on its own. But let's see. I'm looking at the clock, Ryan. Unless you want to look at something else, I think I'm done here.
Yeah, I'll grab it just for a couple just before we shut up shop. Let's grab there. Can you see that all right?
Yep.
Yeah, cool.
Yep.
Yeah, just a quick one. Dollar CAD banging up against this 136.50. It's had a couple of goes, still holding below. Keep an eye on that one. I know a lot of guys in our room trade the loonie. Obviously, with the GDP data coming out, you probably want to ignore this level for over that data. But if you get a spike up 137 into 137, we're looking at the next level, and then to see if this becomes support if we do get a break up above there. But otherwise, for if you're looking at trading around the BOJ, you know, Kay's highlighted Aussie yen as a good pair. This is a time where you do some of your homework and you work out what's going on in one currency versus another. We know Aussie CPI came down. We know that pushes the RBA to a more neutral stance. That is obviously going to be and has been weighing on the Aussie dollar. So if you get something that moves Aussie the opposite way, and that move based on the Aussie fundamentals isn't justified, you know there's a potential opportunity. So if that happens in Aussie yen, that we get a good rally, as Kay says, that's likely to run into trouble, and there is where you look for a potential fade trade. Same with the dollar yen. You know, my big area is 138, 127. You know, a bit of a wide area, you know, huge area if you want to call it that, 100 odd pips. But over something like this, we could get a move up close to there or up towards there. And I favour any sort of rally in yen pairs getting hit, particularly if it's against the dollar, based on the market's mood for the US side of things. So I'll be more a rally seller than a dip buyer on this one, unless we get to some juicy levels down below. Because whatever happens with the BOJ, we will get a pricing reaction. The market will start pricing the BOJ staying easing, or they'll price the BOJ changing tack. And it's when we get these moves that you get the big swings and the big trends developing in some of these pairs. Just like when the Fed changed from telling us inflation was transitory to telling us it's not, and rate hikes and then coming, that's what caused a ton of this. And obviously the Bank of Japan staying easing as well helped that along the way. But you know, when you get banks changing and big banks changing tack and something like the BOJ, you could get a big huge move. So knowing which side of the boat you want to be on when you get those trades, that helps you get into a nice long-term trend you can sit in and hopefully ride for a good amount of pips. So yeah, for the BOJ, I'm short already, and I'll be happy to hit rallies up if we get up to that 138 area, even around 136, 137s. But we shall see what happens tomorrow morning. Maybe some of you will be up at your desks alongside us tomorrow, the guys in the chat room. Until tomorrow, we find out exactly what's happening at the BOJ. Have a great day today. Thank you as always, Kate and Stel, for your valued input, and we shall see you all tomorrow.
Thank you, Ryan, and everybody. Take care.
Ciao.